Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
All right, good morning, everyone. This is the McNichol & Associates Asset Management Research Meeting for Thursday, March the 5th. We're going to get started here with a little bit of a boom. And as always, just drawing your attention to the disclaimers relating to not providing direct advice here. So a little while ago, a fellow by the name of Rob Whitting discovered that if you rent, there's no sort of formal way to bank, prudent and responsible renting. And so what he did was he created a company called Boom, which is essentially in the fintech kind of space. And what Boom does is it takes responsible rent payment on the part of the tenant and reports it to all three credit bureaus in the United States. Thus allowing renters to establish, a credit track record and, transition that into, the mortgage application process and home ownership down the line. So whether you're young or new or transitioning, it's something that, he kind of noticed was a pretty gaping hole in the U.S. residential marketplace. So this really applies to kind of multi-res, student housing, not so much student housing, but student housing, and certainly manufactured housing. And this company got off to a pretty quick start. The latest numbers have the pre-money valuation at around $85 million, which includes a reserve of B stock. But right around now, if you look at the revenues, which we'll talk about in a second, you're looking at an assumptive post-money valuation of just under $100 million. The company literally just got started 24 months ago, and they already made about $5.8 million. So it just sort of was an example of something that, technology and real estate once again came together and exploited, a need in the market. You can take a look at the composition of the B2B and B2C breakdown, and it's fairly it's kind of homogeneous. I wouldn't say it's perfectly balanced, but the appeal to the landlord or the asset owner is that if you have a portfolio of 10 to 15 apartments, including Boom in your residential tenanting app suite, actually smooths out NOI. And so what that does is it sort of gets you out of the way from needing, 90% occupancy for an extended period of time to go back to your lender and say, okay, we're now ready to refinance. It took off really quickly. And, like I said, this is a good example of another company like Grata, which is our other kind of fintech portfolio company. It's amazing to me that, if you use technology and you're smart and you bring to market something that's badly needed, it literally is like a bomb going off. And so the name Boom is, kind of appropriate here. This is obviously a small position. We actually paid for it from, the real estate fund with ad distribution from one of our multi-res properties. So, it's nice to be able to do that and kind of think outside of traditional bricks and mortar. We'll update you on this one soon. I have a feeling it's going to be moving quite quickly. So we'll talk more about it later. In the world of charts of the week, it's pretty clear, I think, if you kind of follow markets or any of the technical newsletters that, we're certainly transitioning from a phase of, new highs. The story kind of went, chapter one was, new all-time highs. and then chapter 2 was new all-time highs, and then subsequently pretty stiff corrections right after a new high was reached, to now where he's saying we're kind of treading water, and there's been more of a pullback underneath the market, which we'll talk about in a few seconds here. But he's still feeling pretty good. He's just sort of again calling out some of these indicators here, and so with the S&P 500. Like I said, it did spend a lot of time in that kind of medium high overbought range, and now it's come down into that sort of underbought range, which potentially is an opportunity to make an investment more quickly. And this is that pivot zone right around 6,900, a little bit more than that. So you can see here that sort of looks like the top of the market being kind of exhausted, if you will. It's come off since that zone, and now the issue here is that we don't necessarily have to have a crash or any sort of crazy movements, but now that becomes an issue of can it get back up over that kind of 6,900 level, and we shall see. This is just a different look at the chart of the S&P 500, kind of more focusing on really just the year-to-date period in 26, as well as the 200-day moving average, which is the blue line. With regards to the channel here, again, it's kind of rolling over. It is now at a position where that 200-day moving average looks like it will kind of step in and act as a barrier to further technical damage. So that's sort of the S&P's price movement. This is where it gets into a little bit more of the underlying internals of the market, and it's really that lower left hand side chart. The percentage of stocks on the NYSE above their 50-day has deteriorated visibly, but it was the case that it's done this before. And some of these broader measures like the S&P 500 equally weighted index, have cooled off. I'm not really sure if that's the right way to look at it, because if I recall correctly, the geometrically weighted S&P was kind of trailing the cap weighted S&P. So this is a sort of a cool off. Sure, I can see that, like we all can, but it's not as bad as some of the other indices. You can see here. The Russell relative to not only itself but the S&P 500 has really changed, and so we'll just have to keep an eye on that. With crude, I think I read something last night where that situation in Iran has really put a substantial damper on the number of vessels passing through the Strait of Hormuz. And there's actually a table coming up on it, so just stay tuned. But for now, I'm not really sure why he puts a chart of WTI up here. It probably should be Brent if he's talking about global oil markets. But just so that body of water on the southwest side of Iran is really a major thoroughfare for oil and LNG in particular. So if you're looking at Sabine or any of these other LNG players, might be time to brush up on your petroleum type of knowledge. He thinks it's breaking out here. It's got a little ways to go before you can kind of make that comment definitively. But certainly, if the situation in Iran continues, you will get more charts or more bar charts like this one here. So the way you look at this one is you go back 2 weeks and say to yourself, how many tankers were going through there? And these were VLLCs, which are the very large, tankers, like the enormous ones that are, I think the VLCC is 400,000 tons plus. So these are enormous tankers that are going through here. And, a couple of weeks ago, there was 50 of them. You could count them from a chopper or whatever to none. Now last Tuesday they actually reported none. A couple of them did get attacked. I think not just because of the military action But in general, it's sort of a volatile region anyway. But these oil tankers, and it's also container ships and bulk carriers. Bulk carriers would be people shipping around iron ore and some of the critical materials and stuff that we sometimes talk about. But certainly the oil tankers have gone pretty much no bid. I know this past Monday it says there was a couple, but I looked into this last night. There's none there right now, obviously. So we gotta watch out on that. U.S. dollar index. I really kind of lost track of the U.S. dollar index. So this is just really a technical chart. I feel, I'm just kind of looking at a picture without getting much out of it. It seems like it's moving around here out of this range, but I don't. If anybody has a better view on the U.S. dollar index, that'd be great. And then just sort of finishing off with global markets. So this is the MSCI All Country World ex-USA, and really the idea here is that it's sold off a ton, and it's weird because when you take a look at this chart, you kind of say, okay, is this a flight to? Is this a flight to quality, or like what's going on here? And I think the weird thing about it is that I wouldn't say it's a flight to quality, because I think bonds actually sold off in the last couple of sessions. Again, maybe Chris or someone else would know, but I guess the inflation side of the house is outweighing the risk side of the house. So that whole argument of inflation versus flight to safety, for now, it still kind of looks like inflation is calling the shots. So I'll pass it back to the team. Thanks a lot. Yeah. So Ken, I don't know if you want to.
Cool. Can you see that now, Joe?
Yeah, Ken, we were able to see that. Yeah.
Okay, cool. So just go quickly through here. Canadian disclaimer: we're not recommending any tax or securities advice. Contact us through our email or website, mcnickelasset.com for Canadians, or mcnickel.com for Americans. Just if you have any specific questions, feel free to reach out to one of our PMs. Quickly looking here, this is just the S&P 500. Obviously, last week we didn't update these just as we're out of town. But a rocky 2 weeks, kind of, with obviously this past weekend, everything coming to a climax, I'll say, with Iran and Israel and the United States. Bit of uncertainty, a bit of a vol increase, a sell signal for the first time this year. And the S&P 500 overall really flat since October, if you look at a 6-month chart. Basically, the sell-off has hit everything in recent months. I wouldn't call it a massive sell-off, but there has been some weaknesses. Tech, obviously. But the strongest sectors this week, actually, funny enough, were energy, which is no surprise. And then software. A lot of the software names, if you really look at it, I don't know how they finished the close yesterday, but I was looking at it midday yesterday, the past 5 trading sessions. Some of the best performing stocks. Now, these names are well off 52-week highs and still struggling, but something I noticed. Looking at the momentum for the S&P, kind of will be the same story on the next slide. And the overbought, oversold, really weak for these growth-weighted indices. You'll see the same thing here for the NASDAQ, which created its second straight sell signal. That's the first time since last spring that's happened. Price objective moved lower. This is the longest negative weekly momentum since last spring once again. It's been oversold 5 weeks in a row since the first time since last spring. So really a lot of breakdowns here for the NASDAQ. The NASDAQ one, this is the NASDAQ 100, also down to start the year through 2 months. Obviously, a lot of the tech names, we'll say, slowing down those high octane returns they've had over the last few years. And I will note, despite some of those tech names pulling back, valuations remain stretched, I'll say, just to say the least, especially for the NASDAQ. Looking here at the Dow, pullback as well. It created a second straight sell signal. That's the first time since last spring. It dropped below some support lines. You can see some blue resistance lines up above. Despite kind of where it the Dow looks like it broke through a zone and approached its trend line. The Dow remains the strongest in my opinion in terms of the technical indicators that we're looking at. Overbought, oversold was still oversold. Just flipped to negative monthly momentum this month, so perhaps a short-term change that can be reversed. But the Dow is up year to date. It's sitting above some crucial moving average lines right now. So we'll have to see how the next couple weeks unfold for the Dow, if it can regain some of the strength that it formerly had, or it's going to join the more growth-weighted index and I don't want to say struggle, but retreat from here. On the other side of the coin, obviously TSX 60, it's been volatile, especially this year with the price of metals going kind of up and down, and the miners trading like yo-yos. But other than that, a lot of the TSX components have reported some really strong earnings, including obviously the banks. Overall, the TSX had a $2 decrease week over week. Energy, really strong returns with the invasion, or not the invasion, but the killing of Khomeini and what looks like could be a prolonged conflict, obviously. Precious metals, obviously, we're up and down this week depending on the day, but I just wanted to look closer to the bottom. P/E ratio, much more attractive than the U.S. indices, nothing new there. But the overbought, oversold sitting at 52%. That's a slight week over week decrease, and the lowest we've seen in 3 weeks. But it still remains very elevated, especially at a time when you're seeing these U.S. This selling in the U.S. market, and where there's an oversold metric sitting below negative 10%. So some real relative strength that we've been able to sustain here north of the border. And then, like I said, I'm going to show this chart once in a while. This is the major U.S. index technicals. You can see the Dow, the NASDAQ, and the S&P 500, how they've performed, obviously, on a weekly, year-to-date, where their support levels are, how they look on an overbought, oversold. Just a nice graphical illustration. As I mentioned before, the Dow Jones recent sell signal, actually the second straight. So technically on this chart, when you're zooming out a lot, looks the weakest. Quickly looking here at the VIX, decreased a little week over week, bit of a volatile week. Obviously that spike up last weekend. Target price moved up to almost 50%. Still see this upward trend moving higher. We did get a breakdown last week and created a sell signal, but returned right away to an increase in vol. We'll have to see if that obviously continues. These technical indicators, I'll just jump through them quickly. They're a little more delayed moving. The NYSE moved 8% lower. Percent positive trend, same thing. These two charts are moving lower. The NASDAQ looks like it's breaking down pretty quickly, the lowest point we've been at on this chart since last May. So really seeing a lot of these companies within the NASDAQ reverse their positive trends that we've seen for the last number of months. Toronto Stock Exchange, no movement there. Here's where a lot of the movement has been over the last 2 weeks. A lot of flow through commodities, no surprise there. We've seen strength, obviously, the last few months in industrial metals, precious metals, now energy. Obviously, there's a play on chemicals here with the slowdown, obviously, of shipments within the Middle East due to Iran's conflict. But you can see here, energy stocks domestically has gained 62 buy signals over the last 5 weeks. There's been strength, obviously, in energy, basic materials, actually financials more recently with some of the strong earnings. Some of the traditional banks and even small cap banks have reported. These are U.S. groups that I'm talking about, not Canadian. utilities, and healthcare. So a rotation into some of those more defensive names and inflation protected industries like energy and basic materials as well. Looking here, crude oil, I just wanted to show everyone knows crude oil has moved up pretty substantially, had a bit of a fallback, but even before we saw that, I had been talking about for weeks, crude oil bottoming at the end of the year, creating those two nice buy signals. This was pre-Israel-Iran conflict. This last line was obviously due to what happened over the weekend. But there's many that are predicting even higher prices. On Monday, oil traded higher, more than I think 6%, 7%. It's the best day almost a year. And according to Dorsey Wright, since 1983, it ranks in the 99th percentile of positive daily returns for oil. So really a historic day. We saw a bit of a pullback. Some traders probably locking in some profits, but we've seen oil move even higher since. So I think there's potential if this continues and it's prolonged, the price of oil move even higher. Looking here beyond that, after we look at oil, just looking at equities that obviously benefit from higher oil prices. This is the Invesco Oil Fund versus the iShares Russell 2000, and this is the Invesco DB Energy Fund versus the S&P 500. When they're moving up, energy/oil, these ETFs outperforming their underlying general index. And we saw obviously this massive breakout for the first time in multiple years, especially at the chart on the left. You'd have to go all the way back to 2023 for a short period, and then even further back to 2022. And really same with the chart on the right with a little asterisk in early 2025 when energy outperformed the S&P 500. So really, I think there will be some flow. I mean, you're going to get some of these algorithms and momentum-based traders that are going to be obviously trading into some of these energy names that have been outperforming for months and really have gotten a huge boost over the last few days, especially if you look beyond the names in energy. You can look at petrochemical companies, tankers, and some other corollaries. Looking here, obviously, crude oil future curve in backwardation, something to watch. It's moved up pretty substantially within the last few days, but we'll have to see, obviously, if that continues. As I said, petrochemicals, looking at this agriculture ETF, there's not a whole lot of ways to outright play through an ETF, the agriculture space, the petrochemical space. But this is MOO, no pun intended. Fund score is about 4.7 out of 6, performing really strong year to date. Still well off 2022 highs when we got the Russian invasion of Ukraine. A bulk of the globe's petrochemicals are exported out of the Middle East or through the Middle East. So there's a lot of arguments that you will see higher oil prices, but the ones that could potentially move higher without action from governments, i.e. the Chinese government selling and utilizing some of their strategic petroleum reserves, or the U.S. doing the same thing, or Japan doing the same thing, are increases in the prices of these petrochemicals, which could really benefit a number of U.S.-based companies that are trading well off 52 weeks highs. They have had a good start to the year with some of the conflict going on, and obviously gotten a nice boost this week, but still very attractive from valuation and technical analysis side. As I said here, chemical stocks, large gains last few days. You can see here compared to the S&P 500. But like I said, around 15% of global ethylene or polyethylene supply is directly impacted by the conflict, which will impact prices. So we'll have to see how sustained, obviously, this conflict is. Private credit, obviously, the meltdown that we've seen. I hadn't checked in on a lot of the sponsors that are publicly listed that are in the private markets, like Ares and Apollo and even Blue Owl. But the collapse, obviously, in Blue Owl shares pretty sustained. Obviously, they had to put the gates up on a private credit fund. Blackstone a couple days ago had mass redemptions. They fortunately for them, they did not have to put up the gates, but still huge outflows you're seeing in the space. And I think I have two more slides. This is just South Korea, something very interesting. We own South Korea. A different thing that I've learned about the South Korean stock market is a bulk of their market is retail traders compared to the US and Canadian markets, where a bulk of it is institutional. So you get these massive moves in the market on a daily basis. The South Korean market is up about 35% year to date right now. It's been down 15% over the last, on Monday, Tuesday. Really trading like those meme stocks back in 2021, 2022. Why is that? Some people are speculating just valuations have been a little stretched. The reliance on two companies within South Korea, including Samsung, making up a bulk of their index. But then there's also worries that South Korea really won't. They're going to be kind of struggling to source energy, as 90% of their oil is imported and 75% of that is from the Middle East. So they could be one of the developed countries that is impacted by this conflict prolonging the most. So something to watch there. And then last slide, waste management bounced back since this mini sell-off that we saw to end last year in the fall, up about 11% year to date. It's trading slightly expensive, but if you look at it relative to the industry is trading expensive, and it's below the median and average in terms of earnings, forward earnings, enterprise value to EBITDA. Just a really attractive company that's obviously has some downside protection, I'd say. I mean, no company is going to, I guess, if there is a market crash, obviously even these stable and quote unquote recession proof companies will more than likely pull back. But I think right now, highly attractive company at this price that provides a little safety, I'd say. And that's it for me.
Okay, great, Ken.
Good morning, everyone, and welcome to this morning's brief update from March 5th, 2026. My name is David Clark. I'm one of the analysts here at NASDAQ Dorsey Wright. Positive action during Wednesday's trading, ending some of that notable negative action we saw to kick off the week for most equity indices. NASDAQ 100 leading the way to the upside, up over 1.5%. Saw it developed and international equities both up over 1% there. U.S. equity index is positive, sort of the laggard of the group is the S&P equal weight there, up just 40 basis points. Bonds basically flat, US dollar down about 29 basis points there. Now, looking at the chart of the Dow this morning, did see ultimately that yesterday's action brought it back into a column of X's there to 48,800, still technically maintaining a sell signal. We'll monitor this bullish support line here very closely, as that's where we sort of settled just above at 47,800. Bullish support line now at 47,600. That'll be our level of support that we keep a very close eye on here in the near term. As for other U.S. equity indexes, we did see most move back into a column of X's following yesterday's trading. Not quite the case for the S&P 500. The moment it takes a move above 6,900 in order to see it return to a column of X's. Still holding support there at 6,750 though, so a bit of a silver lining. Not much indicator action from yesterday after we saw quite a few of the NASDAQ Dorsey Wright and other bullish percents reverse down or at least moved lower with Monday and Tuesday's trading. We've at least sort of seen the action at least stop for the moment in time, or at least hit a pause, if you will. Now, we do see at this time being more of the 40 sectors maintaining a column of those versus a column of X's. So we're still seeing technically decreasing participation for most of these, but there are some that you should keep an eye out on. Among those, we did see reversal back into X's for the software sector. So slight silver lining there as far as other action may go. Now, looking on to individual stocks, we did see Broadcom report a beat in this morning, seeing shares at least trade higher. Now, we read quite a few headlines this morning that said it failed to impress investors, but at least for the moment, last we looked, it was trading up near 336, showing the potential of moving back into a positive trend, not only giving a buy signal, but moving back into a positive trend. So keep an eye out for that for AVGO, as that's what it appears today's action may have in store for it. Trade Desk, another one where we're seeing some pretty notable upside action this morning after it was announced that there were early discussions with OpenAI along with a couple other groups about settling ads. So Trade Desk at this point seeing shares rally up towards this $30 level, up over 20% this morning. So seeing a pretty good move to the upside here, but still going to be one where we're seeing an improve out of oversold territory. So just worth bearing that in mind for that 0 for fiber, even though you may see it on the headlines this morning. Upcoming earnings, Costco will report later today. Maintain that buy signal since January, second coming with that spread triple top there at 1,008 at the moment. Support there at 944 as well as at 848. Prior resistance from those highs at 10,056 and 10,072, or 1,072, 1,056, pardon me there. Last but not least, as far as upcoming earnings, Marvell Technology, MRVL.
Okay, that's enough on that one. Okay, just I'm going to be brief this morning. Michael Coolbaugh didn't come through this week. He must be off. So I'll just cover quickly what the indices are looking like. So Toronto up 7%, Venture up 9 and a bit, and green just about everywhere else. India's lagging, down 6, and Germany's gone into the red, and really nothing happening in the U.S. Flat for the S&P, down a bit for the NASDAQ, and up a bit for the Dow. So not much happening there. Whoopsie, just jumped on me there. Oil, as we know, with the things going on in Iran right now, up 30% year to date and up 14% over the last week. Hopefully this will settle down. We're going to start feeling it at the gas pump now. And nat gas really has not been affected, surprisingly enough. Gold sort of holding in there, up 18% for the year to date, and silver just behind it. And copper, not doing much there. I'll do the Canada US dollar and interest rates on the point and figure right here. So Canada US dollar, nothing's changed, still around 73 cents. Short-term measures up to 78 and long-term measures down to 62. So it's really just stuck in a box there. Same thing for the US dollar spot index. ICE is really at 99 and trying to break out above to 103.5 after being down all of last year. And moving along here. Okay, so crude measures higher from 75 up to 81 still, up 30% year to date. Nat gas measures down, and the producers really look to be flat. Copper futures pointing up, and uranium down. Gold still has on the futures a $6,500 target, but the spot is measuring down. The producers both are measuring up, both the gold bugs and the VanEck majors, and the VanEck juniors also measure up. So the precious metal, at least the gold precious metal, looks to be in the right direction, whereas silver looks like it's taking a bit of a pause here, except for the miners. So sort of mixed messages with silver. And platinum looks like it's ahead of itself and coming off. There's that same target price for Bitcoin of 22,000. So not looking good there. Ethereum up and Solana up, and the crypto index. So that's sort of flipped over now. So all the other players in the digital space look to be heading up, except for crypto. Finishing up here, I'm just going to go straight to interest rates and then pass it on to Sean. So the 2-year is down a little bit to 355, measures down to 2 3/4. The 5-year measures down, the 10-year measures up, and the 30-year measures down. So the same sort of a sine wave interest rate curve right now. And that is it for me. So Sean, you want to take it away?
Yeah.
Go for it.
All right. Okay, macro overview, not investment advice. March 5th. So what's happened? Well, the war started. Hasn't helped the portfolio returns significantly, but we're going to talk about some interesting things. We're still working with the reduced cash position. Allocation to base metals, defense, silver. Silver's worked out. It's coming off a little bit, but I'd keep your eyes on it. The debasement trade, while the dollar is stronger, is still in play. I've got some tech, some broad equities. Overall, I think 2026 is going to be more constructive with an administrative put to support the election cycle and the big, beautiful bill stimulus coming into play. Now, the crypto market is still broken, but there have been some positive developments. Big picture, not much has changed. Oil is priced for war. If it goes up a lot more, that's going to be a global tax on the world. Everything else is pretty much the same as last week. What's paused is the breadth in the S&P has, again, taken a pause. We'll see that in the technical indicators. We were hoping for a nice broad participation that would overflow into small caps, but right now that's on hold. We're seeing continued deglobalization, de-dollarization that's ideally going to lead to a big reshoring of industry into the U.S. On the back of this war with Iran. I think that's going to get accelerated. Asset classes, we're looking at it just over the last week. Most of the asset classes can be explained by the movement in the strength in the U.S. dollar. Gold, U.S. dollar's up, everything else tends to be priced against that. So it's dollars up, everything else is down. And we see that across most asset classes, except for the big move in crypto yesterday. And of course, crude since the invasion or the attack on Saturday. Economics, pretty much all the same. Policy is still dovish. Growth slowed a little bit by the Atlanta Fed. We were at 5.4 at one point, 3.1 last week. Now we're at 3. Recession, still not now, but if oil were to double, it would be a pretty big deal. The US dollar, as Joe was talking about, is showing a little bit of strength. It's up 2.7% in the past month. I consider this the biggest asset class in the world. And a move up in the US dollar means that everything else tends to be priced down against it. And it's a flight to quality, the classic, flight to quality in a time of war and uncertainty. Gold, strongest macro asset we've got. The trends are just rock solid right now. We're seeing de-dollarization. Other than the margin mayhem that was caused back at the end of January, it's just hopefully has legs. I can see this going. God knows, 20 to 50% higher over 12 to 18 months. Silver had, like, if you look back at the end of January, the one thing that really gets the exchanges worried is when you have these massive changes of price in very short periods of time. And the end of January was very concerning to the CME, to actual industrial users who are probably complaining like crazy. So they adjusted margins, not just from like a dollar basis, but they changed it to a percentage of price, which I think in hindsight was like effectively a 30 or 40% increase in margins. And that just crushed it. We had that huge down day, but it is recovering. Demand is still there. Solar demand is just through the roof. On a targeted basis, maybe $60 is the right price, but it has gotten a speculative bid to it. And a physical squeeze will push it up above 100. Oil, is it in a bull market? This is a war bull market. So I'm expecting, as Ken was pointing out, things to fall back into backwardation, and we'll be back down in the, maybe the 60 level, 50 to 60 level in the next few months. Here's the backwardization chart, which I stole from Ken. You can see that the forward market is pricing, a return back to like the low 60s. Rates and credit, I mean, this, other than high yield, this has just become an incredibly boring market. Just nothing is happening. Everyone's waiting for Warsh to come into power at the Fed. But the spreads on high yield are out again. So keep an eye on that. It's all downside for credit, really. U.S. equities and the sentiment has moved from neutral last week back into fear. I think that gives us room for upside. But we've seen substantially weakening trend indications. Breadth is narrowed. The term structure is flattened, but still normal. Let's take a look at that. You've got the spot right now sitting on top of the front month futures, but still slightly upwardly sloping, which is what we want to see. If things calm down, I would expect to see VIX between 15 and 20 and a normal shaped curve, which when it happens, and knock on wood that it does, that'll be constructive for equities. Speaking of equities, this is just a flat trend. It's just going nowhere. It's stuck in a box. The rotation from the Mag 7 to broader participation has slowed. The AI spend is being questioned. OpenAI is apparently pulling back on some of its spending. Anthropic is making huge gains in revenue relative to OpenAI. OpenAI is now committed to the Defense Department. The big chatter in the Valley is from Alex Karp at Palantir that said, like, if we don't work with the government, as Anthropic rejected loosening their controls for the Pentagon, Karp said, if we don't work with the government, they'll just take what we have. They'll just nationalize our technology. So work with the government. And OpenAI is trying to do that. Anthropic is now apparently backpedaling. So if we look at the volume profile, you can just see, this huge amount of price basing up at the 68.70 level. You look at the slopes of these two regressions. We see the earlier regression fit, having a nice narrow range in a nice upslope. And you can see it's tilted. And it's tilted and it's gotten wider. So that's kind of classic signs of a top. We need to see the spending kick in and this the war risk premium evaporate. And a part of why it's not moving out of this range is NVIDIA. NVIDIA is stuck also in a very narrow box since literally like last August. They funded $30 billion of investment when they apparently had said it would be 100, but I heard up to 100. So there's, OpenAI is getting a big question mark beside it. And if it seemed to fail, it's going to re-rate the whole market. Crypto, it's better, but early, right? And the big thing that happened yesterday is that Kraken was given access to the Fed system. Just on that, Bitcoin's up 7%. The follow through on that is that Coinbase is going to get that. And that's one thing I've consistently had on this slide is we need Coinbase to have access to the US banking infrastructure. If and when that happens, I would expect you to see Bitcoin ATMs all over the United States in 6 to 18 months. I mean, it'll be as prolific as Bank of America. So is Bitcoin breaking out? You can see it had a base there on the price action. You can see that the heat map just below the price chart has started to clear. Some of the longer term averages, which are in the green, are still risk off. But on the whole, this has been a very constructive couple of days. Also to note that inflows into the ETFs are very material right now. And bizarrely, yesterday, Scotia, which was one of the most crypto-hating banks in Canada, launched an actively managed crypto ETF. So, there's that saying, slowly and then all of a sudden. I think that's coming true. Again, this is going to be a tough year. We're in the fourth year of a 4-year cycle. I see downside, potentially being 35 to 45,000 if things don't, work out well with legislative action in the U.S. Like a little post trade on something I put on last week is I bought call options on USO representing oil. Last week I did the March 2088 calls. Market popped on Monday. It's almost tough to sleep on Sunday. I was anticipating this. The early move was the biggest move. It faded a little bit during the day, and I took my profits. The lesson there was when you're up over 100% on options, maybe take out the principal and let the rest ride as retail catches up. And then the cartoon for this week is the whole point of private credit was to keep the bad results private. You see KKR, Carlyle, Blackstone, and Blue Owl. Blue Owl is just getting decimated, but I can tell you, having worked in credit for a fair bit, what's going on behind the scenes is pretty concerning. And when it's private, there's no easy exit. But I can tell you that all these guys are trying to figure out what to do right now. That's it for me.
That's a good one. Thanks, Sean. Did Chris Curry join us today? I think I saw him trying to get in on the other platform. Paul Beatty, do you want to update us?
Yeah, hi guys. Well, Sean, I have a question for you. How significant is this? This private credit, like this market? It's like $2 trillion. I chat GPT that this morning. It's $2 to $3 trillion. I mean, is this big enough to cause a major problem for say the financial stocks and maybe the markets overall? I mean, how concerned should we be? I have no idea.
I'm not super concerned right now because it is private, so it was all funded, right? And it's funded by non-bank financial institutions. So that's overall good. If it was all, if this was all on bank balance sheets, it would be a bigger problem.
Right.
Right. Because in private credit, you're not levering up 20 times.
Well, are these funds all levered up? Do you think a bit? I mean,
maybe a little, but not much. Like Blackstone goes out and raises $20 billion and then puts it to work in private credit. We've seen, numerous deals be marked at par and then go to zero, which to me is just beyond belief. Like part of my job when I was at TD, when I was running the loan portfolio, was we could mark the line of credit to a convenience store, right? And for these guys to be that offside, to go from par to zero, it just shows a real lack of controls. And I've seen that before. So guys will be swooping in. You're going to see these same funds create distressed private credit funds. So, and then, like it's just rinse, repeat.
Right.
So it's not as big a problem as say even the CLEC crisis back in 2000, which was off of banks, or certainly the financial crisis.
Right. And these things don't go to zero, right? An entire fund, let's say they have 15%, 20% of their portfolio goes to zero. They'll be disappointing funds with losses, but
well, the typical recovery rate in levered loans is in the high yield loans, about 30 to 40 cents on the dollar.
Yeah.
okay.
Yeah, Paul, I like that cartoon because it said, like, it essentially says, what do we not know? And when when Go Easy kind of came under attack, what kind of stunned me personally, I mean, you guys make your own opinions, was this whole $300 million of delayed credit losses, and in particular the way these skips or partial payments essentially rewrote the current status of a borrower on paper. And I mean, if you owed me money and you owed me $300 million and you paid me back $5 and said that I'm going to mark you as being on side, I mean, it seems like some of these guys are really systematically inflating their reported earnings to LPs.
Yeah.
And so this could just be starting. I don't know. Because we don't know a lot of, like, we usually with private stuff, you only find out like 6 months after something really bad happened. It sort of gets reported.
I mean, one of the biggest worries for us is the U.S. not private. I mean, I know nothing about private credit, but in general the buyout funds, the venture cap funds, the private equity funds are going into 7, 8, 9 years of no returns, right? And so we know a lot of investors that are have put their money up for extended periods of time, and they're not getting any liquidity at all. So these funds are stretching into their 10th year, and there's nothing coming back. And so the IPO market hasn't been that great, and we have one client in particular went down and said, I want to sell a bunch of this stuff, and went around looking for bids. And he was being bid on all the funds at like 30 to 35 cents on the dollar. So I think the bigger issue is, as Wall Street basically, marked the entire private equity world to unjustifiable levels, right? And if the IPO market doesn't open up, this year or soon in 27, then we're going to have a problem, liquidity problem for sure in private equity in general, which is, of course, a huge market, right? So anyway, 30, 35 cents on the dollar, can you imagine? Of course, you're buying into a fund where you have no liquidity, right? You inherit all the assets in the fund, but you have no real timeline. So no wonder these things are not well bid, right? Anyway, I think in commercial real estate we've talked about, right? In the U.S., commercial real estate is for sure overly priced or overly valued. So I think the private equity in general is overly valued, and the public markets, frankly, aren't going to take the IPOs at these stupid valuations. Except, of course, the big one's coming, right? Elon Musk is going to bring SpaceX public, and this will probably be the defining story of this year for the markets, right? So he's going to do 1.5 trillion. Is that the number you guys have heard? And that's going to be a big boost to the whole private equity world, because at that valuation, a lot of funds are going to get skated on side or get a nice big boost. So we look forward to that. We're watching it like a hawk. Where MDA, right, came out. The only two investments we have in the space industry are MDA and Telsat. You look at the charts of these two things, it's fabulous. I mean, Telsat, I think, is going It's breaking out right now to its 5-year high. It's right at that point, and I don't know. We think this thing could be worth 3 or 4 or 5 times what it's trading at right now, and it could all be done this year just because Musk takes SpaceX public and therefore Starlink public, and they say Starlink's worth $1 trillion. Well, Telsat's got to be worth, I don't know, 15, 20 billion, something, because everybody in the world's going to want to do business with Telsat because they're going to want to have redundancy and not do everything with Elon Musk, right? So, and you know that, right? You know everybody's going to look for redundancy. They just want a backup plan for their satellite business. So I think Telsat's like one of the only plays, and so it's very exciting, right? NVDA, by the way, came out with their numbers. It's our second largest holding right now. Stock was up 7% on the news. I don't even understand why, but anyway, good news, and the markets liked it. And I think those are the only two must-own companies in Canada, right? If you want big upside without taking much risk. So, and we don't know how to play the oil space because I don't think nobody we've spoken to can tell us for sure how long this situation is going to last in Iran. So this is the big question mark, and I don't think anybody has an answer. So how do you play it? I don't know. I still think Canada's cheap. I'm going to send you guys a comp chart we just put together on the silver companies, and particularly the silver companies that are going to restart their businesses, right? Restart their mines either this year or next year. And we've got some comps, right? You just do the math and, assume they're going to do what they say they're going to do, restart their mines. You know what the price of silver is, put it in at, I don't know, $75. You know what the cost is, probably around 20. They'll be the most profitable companies listed in the stock exchanges. And so we think it's a very exciting place to make serious returns this year. So I'll send you what the work we've done. And basically, there are a bunch of companies that are trading at under 3 times EBITDA, 2027 EBITDA. And I just don't think stocks are going to trade at 3 times EBITDA in the silver space. That's not going to happen. In fact, the argument is that they'll trade up to a premium, like 15 or higher. 15 times EBITDA is, and so you're going to make a pile of money if you own a couple of these things. So I promise I'll send that to all you guys today. And that's it for me.
Hey, Paul, did any of your folks attend PDAC? Just finished yesterday, and sort of wondering if we might see an uptick in press releases or any deals coming out of the old PDAC conference.
Yeah, I mean, I think most of the guys that are in the mining world are convinced that we're in the 3rd inning, not the 7th or 8th inning. Okay.
Yeah.
So I think that's the general tone, is that this is, of course, they're all biased, right? So who really knows? But I think what's going to happen is there's going to be a lot of deals. There's M&A is going to start at one point. There's going to be M&A, and these companies are cashed up. Some of the mining companies are going to be the most profitable companies on the stock markets worldwide. Like, that is going to happen. The margins are going to be, some companies are going to have margins just like software companies, like 70% gross margins. I mean, so if that happens, which is going to happen because the gold doesn't even have to move anymore, silver doesn't even have to move, and the margins are going to be there. So if that's the case, how is the stock market going to ignore these things? And this guy, you've seen Ray Dalio, right? He goes on TV every day, every single day, telling Americans that they should own 15 to 20% of their liquid net worth in gold. Like, this guy is no fool, right? And he's uber successful, and he's telling Americans go 15 to 20%. My partner Jacques did a rough calculation, right? The value of the American liquid net worth, it's something like 150 trillion. So if you take 15% of that number and say, okay, they're going to, well, if you take 5% of that number and say Americans are going to go buy gold, well, that's going to send gold alone to $20,000. There's not enough gold in the world. So this is Ray Dalio telling everybody, and you think we're bullish on gold. We've talked about it 100 times. None of us have been saying 15 to 20%. We're kind of all at like 5. And so these are interesting times. And I don't know. I mean, and you've seen the American banks. They've all come out in the last few weeks, all with forecasts on the price of gold up, high 5,000s, low 6,000s this year. And I've never seen that in 40 years. I've never seen that. And if you ask Royal Bank of Canada, RBC, our biggest bank, ask them what their forecast is on gold. They don't even put one out, I don't think. But if they did, it would probably be down $2,000, right? So they're very conservative. All the banks, except maybe BMO, don't even comment on this space. And so, anyway, the American banks are doing it. So that's very interesting. So what do they know that the rest of us don't know? So I think it's the best place to invest. I mean, so PDAC in general is like, hey, we're in the third or fourth inning, maybe here, and there's lots of room to go. And wait till M&A starts. How's M&A not going to start? Right? How's that possible? These companies are all cashing up, right? Every quarter they're Agnico Eagle. I mean, they're going to be sitting on $20 billion in cash pretty soon. What are they going?
Well, they've already done some charitable flow-throughs through a lot of these juniors, and Agnico, all these guys.
So anyway, good space to be in, I think, and so it's game on. So I mean, I would anyway. Fun times.
Yep.
Okay, that's great. Thanks, Paul. Gilbert, you want to finish up here, please?
Yes. So this is the short report for Thursday, March 5th. S&P 500 again. We're in this sort of channel here, as Joe pointed out, and I think even Ken pointed out earlier today. We can see here that we've done nothing essentially for 2 quarters, right? We're going side to side, and I think the really important question here is whether we're going to break out higher or move lower. And to answer that question, I think all you really have to do is look at relative valuations. CAPE ratio, we've looked at this before. Not only is it starting to kind of roll over a little bit here, but after peaking above 40 for the first time since the dot-com bubble, it's now under 40. Credit spreads, once again, we've taken a look at this quite a bit in the past. We can see we're starting to rise up here. And again, just from this area right now, this is not an area from which we're starting to see, or which we typically see looser financial conditions, you typically get tighter financial conditions here from these levels. And that's why when you're asking the question, is the S&P 500 going to break out from this range, you have to look at stuff like credit spreads, which have told us that that's actually not the case. Defense versus growth, which we've been looking at for some time. Again, we've had a little bit of a pause here, not necessarily because there's been a near-term rotation into growth, because the market itself has kind of slowed down a little bit. And that's why we've seen new proximate lows. We could say that might have been due to the invasion or the attack in Iran, but to some extent it is in the charts here. Market breadth as well. We've been talking about this red band, which has been essentially the limit since the decline in April of 2025. We reached that earlier in the year, and we've been pulling back ever since. And now we're starting to see the participation, which has been robust up to this point, start to deteriorate. And that's something to pay attention to, because more than 60% of S&P 500 stocks were currently beating the index, right? And so what does that mean? It means broader market participation, but it also means that participation is what is holding the index up to this point, as the larger names are really starting to slow down a little bit. One more chart here. This is the NASDAQ versus the M2 money supply. So you can see we're back at levels well above the dot-com bubble, and this does not look sustainable in the least. If you're concerned about that, then we do have a low-cost tail risk hedging solution with our partners at Universa. Reach out to us if this interests you. So that's it for me. for today. Anyone else?
No, I think that's good for today. Does anybody have anything else? I'm going to go jump on that king set call, Joe. I'll talk to you all later.
Yep.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.